My name is David White. I'm a financial trader here at Spreadex. So things like gilts, treasury bonds, they are government debt. So the government will fund itself by issuing debt to the market. So the UK government at the moment will issue gilts over different time horizons. So you can have 1 year, 2 year, 5 year, 10s, 20s, 30s, whatever it might be. I'm not so sure on that. But essentially what it is the government will borrow money, and in return it will pay an interest rate to whoever is lending the money. And so you can trade things like gilts, bonds, which is the German form of government debt, or treasuries, which is the US form of government debt. And these instruments, we've had a bond rally for about the past 30 or so years, where interest rates across the developed world have been falling in sympathy with a very well bid bond market. The bond market is believed to be less risky than the equity market. So when the equity market is down and risk is being sold, the historical correlations will imply that bonds will be well bid and will want to be owned by market participants. But that's not always true, particularly if you look at something like European peripheral debt, the bonds from Spain or Italy. It's a very good example where the market loses confidence in the ability of that country to pay off its structural deficit and to actually make some output, have some growth. And as a result, the market won't really want to own the country's debt. And as a result, the interest rate that the country has to pay to roll over its debt and borrow money goes higher, which then also puts a clamp on its GDP, and it becomes this negative reflexive process of bond prices going lower, yields going higher, and the country is suffering as a result. So when the ECB last year came in and said we will do whatever it takes to keep the monetary union together, you saw these bonds improve. But generally when traders talk about the bond market and fixed income, they'll be talking about treasuries, gilts, bonds as a proxy to the safe haven play. There's been talk of a rotation from bonds into equities because the bond market has performed so well over the past 30 years, and there has been some breakdown in the historical correlations recently, but real evidence that money's been moving away from the bond market hasn't yet materialized.
David Jones, and Chief Market Strategist at IG. I think now here we are at the beginning of 2013, and we've seen a cracking start by the stock market to the year, and there is talk that institutions are switching out of bonds and going into equities, and that's why many people expect the stock market to do even better this year. We'll see how that actually pans out. But I think over recent years, spread bet clients have become more aware of government bond markets. It's probably one of the least popular markets historically, the likes of gilts, euro bonds, US T-bonds, but I think as we have seen government bond prices hit the news more over recent years because of the debt situation and the concerns about countries going under, clients have had more of an appetite of trading government bonds, and it tends to be very news driven. When we had concerns in Italy towards the end of 2011, we saw a definite spike in trading Italian BTBs, the Italian government bonds. So I think people are very influenced by what they're seeing maybe on the news or on the financial websites, and that's where we see activity in spread betting on bonds pick up. Ultimately, it's the same as any other market. If you looked at a chart of gilts or the bonds, it's like the FTSE goes up, it goes down, it goes sideways. We see there's plenty of volume in the real underlying markets to add volatility, and I think in recent years we've seen clients developing more of an appetite for trading government bonds. Not so much when it comes to trading them, to spread betting on them. If you're looking to dump a load of money into real physical bonds, then it's a classic safe haven play. You won't see much return for your money, but hopefully your money will still be in there in a year, a couple of years' time. So from an investor's point of view, yes, I think it is seen as you park your money there and forget about it. But from a short-term trader's point of view, you can still see plenty of volatility, 50, 60, 70 point moves a day in German bonds, so there's plenty of opportunity there. The same way if you're looking at the FTSE or euro dollar to try and make money both ways on them.